at least we can say that the trade war also somehow has arrived in the US equity market, I think, which is a positive sign in the sense that it probably can help accelerate the negotiation together with the US. And we have seen the meeting is set up on the 20th of November, so in the G20 meeting in Buenos Aires. So we do see a little bit more compromises or willingness at least to have a discussion, and that could help in terms also of sentiment, because I think that's one of the key concerns. Now, looking at the market still over the last, I would say, 3 to 6 months, China has suffered a lot, the US much less. We do see value in China out of that, and we do think that the trade war implications are here, but probably even weigh more on the growth side, on the US side. And if you look at earnings in China, it's still growing around 15% this quarter, and we see a slowdown for next year, but there's so much value, and particularly if you look at the financials, they have done very well. Also in the third quarter, margins are actually increasing, and we see actually that dividend payments are still solid, and that's probably what we would focus on.
The financials are one area. We'll pick up on that in a little more detail in a second. But I'm curious about your views on tech and whether or not there is any takeaway from the earnings we've had in the US in tech that you can extract for big tech names in China, specifically those listed in Hong Kong. We think of Tencent, because for a while there, when we would see the sell-off in the FANGs, people would say, ooh, look out for the bats. Do you think now that we've got some good news coming from Facebook, that should spill over into those Hong Kong listed shares?
The Chinese internet companies really suffered a lot because of trade war, because of regulations that happened in China, and then also because of the general sell-off in the tech world. So the earnings that we have seen out of the US definitely encouraging. We will get tomorrow earnings coming from Chinese companies in these directions. Yes, we do see value, and I think it's probably the adjustment that has happened. The strong selling should be over. We see strong rebounds already today over the last couple of days, and it's looking like they're looking for a bottom, and we do see value in these names.
And Adrian, when you take a look at what's happening with the U.S. trade deficit, it's up 10% year on year. How worrying is that? Is that something that the president should be more focused on than the trade war itself?
Well, if we look at the current account deficit, I think we don't really expect that this should be improved out of this trade war discussion, particularly if it's remaining a China-US trade war. There are other ways to channel basically trade into the other direction, but we also think that the US actually will start to be impacted out of that. We actually can see in the second or in the third quarter GDP numbers in the US, inventory buildup had happened, and therefore we actually do expect that the growth slowdown in the US will become much more obvious, and that could help in terms of negotiation. It also could help basically that the Fed may step back a little bit, and particularly in the first quarter of next year, maybe even second quarter of next year, and go a bit more on hold, become more dovish. That should basically bring also a break to the US dollar strength, and that could bode well in particular also for Asian assets and Chinese names.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.